All right, guys, let's just quickly take a look at that NFP jobs report that we had on Friday, because there's a few questions, about the discrepancy that we had between jobs and the unemployment rate. That discrepancy being the fact that we added 272,000 jobs to the US economy, but at the same time we had the unemployment rate ticking up to 4%. So a lot of the questions revolves around how exactly can we get to these different numbers, these vastly different, this big discrepancy. Now, even though there's what you normally get when you have this type of discrepancies, there's a big cohort in the markets that always shouts, manipulation and stuff like that from the rooftops. But there's normally, when you have these types of discrepancies, there's normally a very simple, very logical, far less sinister explanation for why we have these divergences. Now, when it comes to the labor market or the US jobs report, we have to always understand that there's two surveys that makes up the jobs report. You have the establishment survey, which covers your NFP number itself. That's where we get the 272,000 from. And then you get another survey called the household survey, which covers things like your unemployment rate and things like the participation rate. So just knowing that alone shows you that, okay, the establishment survey came in super, super hot. But the household survey came in with a big deviation to the downside because the unemployment rate ticked up and participation fell. Now, if you look at this from a data point of view, this is what the two data series looks like. The orange one here is normal NFP based on the establishment survey. And then here is where your 4% unemployment rate jump comes from. That is your household survey, which showed a big contraction. Now, there's a couple of things to take away from this. A lot of people out there says that this isn't the right way to do things, right? We shouldn't have these two reports. We should look at one set of data. There's many arguments for and against it. At the end of the day, the markets doesn't care about any of that, right? We've had these discrepancies so many times before. Oftentimes when you had a big miss to the downside, the next month sees a big recovery. Not every single time, but usually you see this data mean revert. It's pretty noisy. And you need to keep that noise in mind. That's why the markets normally look at this and say, yeah, okay, fine. It's one of those months again. It's one of those big discrepancy months or big divergence months. But doesn't mean there's weird, sinister stuff going on in the background. We always need to keep that in mind. There's normally a good reason for it. So when it comes to that discrepancy, was it a mixed print? Absolutely. I mean, it wasn't a perfect tradable opportunity because non-farm came in super strong, wages came in super strong, but we had a miss in the unemployment rate. But when you have so many elements coming in so much hotter than what the markets had anticipated, for me, that was enough for a trade, right? I hated the fact that the unemployment rate came in higher because that was a clear miss, especially when you consider the forecast distribution, right? The forecast distribution showed us that a number of 4% would have been a big deal for the markets. And again, it was a negative number, but that one negative number wasn't going to be enough to trump, this type of beat to the upside. I mean, that was a really big beat. We knew anything above, looking at the forecast distribution, we knew on Friday anything above 230,000 already would have been a big surprise for the market. So coming in above the market's maximum expectation on that, it was a really big miss. So just wanted to do a quick video on this just to explain why we see those divergences from time to time and why the markets usually, they ignore those types of discrepancies because we've seen it many times. It oftentimes just leads to mean reversion. And it's really not, nothing sinister by any means. It's literally just two data series. And those two data series can sometimes show us different things. At the end of the day, there's a lot that you can pull out from any one particular data series or any particular, data set to confirm your priors, right? What I mean by that is if you go into a jobs report, if you went into the jobs report on Friday and you are super bullish on the US economy, you are going to be fixated on that 272 number. You're going to be like, wow, yeah, that's great. If you're super bearish on the US economy, then you're going to be focused on the negative 400,000 number, right? You can find something to confirm your priors with almost every single data number or data set that we get. But the good news for us as risk averse traders, we don't have to worry about all of that stuff. We don't have to worry about the very, very, very smart people afterwards who tries to tell us, the 1,000 different reasons for why this was actually super bad or why this was actually super good. We don't have to worry about all of that. The thing that we're worried about is that, okay, do we have a threshold for where we think the markets will be really surprised to give us enough directional volatility to take advantage of? Yeah, we have those numbers. If we see the print outside that range, outside that threshold, we have a high probability of a high conviction trade, which we got on Friday. So there's no reason to, go and find those sinister reasons and, all sorts of different stuff that we pull out. Sure, it can be very interesting when we look at the data under the hood. And I do encourage everybody to look at the data under the hood, right? At least to understand where it's coming from. But do also understand that you could have all of the information under the hood for each and every single data point that's released. It doesn't mean that you're gonna, that in itself won't make you better at trading the events, right? What will make you better at trading the events is doing pre-event analysis, understanding things like pre-positioning. If for those of you who watched the preview video that we did on Friday, we spoke about pre-positioning so many times, right? The dollar was trading at 2-month lows. Yields was trading at 2-month lows. We knew going into the print that an upside surprise in the data would have been a big deal purely from a pre-positioning point of view. So again, when you approach these data points, make sure that go into the details. If you like the details, by all means, go into as many of them as we can. I do encourage that, but I would also encourage you not to go so deep that you miss the forest for the trees. Sometimes you get analysis paralysis to some degree, right? You go so deep that it just doesn't make any sense anymore, or you go so deep that you're so overwhelmed that you can't make a decision. You can't trade something. So don't go so deep that you just can't pull the trigger at the end of the day. That's I think from a tradability point of view, we don't have to go so deep. What we do from a pre-event analysis point of view, I think is already good enough to give us a possible edge if we get that type of threshold that we're looking for. So that's just a quick video on that report, on that seeming discrepancy, and why we don't always have to go and find a sinister reason for stuff. There's normally a very good logical explanation for why we see these types of discrepancies occur.